I think that one of the things, at least people that I speak with, it's the volatility. Is lower vol really critical in the adoption process, or are we just going to have to live with this vol because it's new, people don't understand it, the
I think the
technology?
volatility is falling consistently.
Hmm.
I mean, it used to be in the first decade, the market was dominated by individual leverage traders looking to make a quick buck.
Right.
And then you had these hyperbolic, parabolic runs, like goes up by a factor of 10 and it crashes by 80%.
Hmm.
But I think that that changed after March of 2020. And then the institutional money started to come in and they crowded out all of these early, leverage traders. And in the newer market, the institutional buyers are buying in an allocation in lieu of gold. And your use case is, I'm just going to buy 100 million or a billion of it, and I'm going to hold it for a decade. And I'm not buying it with leverage, and I'm not buying it so much to flip it. Like they have a different time horizon, and if you look at the trading since March, it was more like it runs up 25%, or it runs up 40 or 50%, it comes down 25%, and it runs up 50%, it comes in 20%. And so the kind of volatility started looking like more common high growth big tech stock or something. And if you look at the volatility today and you compare the volatility of equities versus the volatility of sovereign debt versus the volatility of Bitcoin, they don't look that different, really. I mean, the other day, the 30-year treasury swaps, they jerked like 11, they were down. The yield on a 30-year treasury was off 6% in the day, or 5.5%. And it was the most volatile thing on my screen.
Right.
And so, I think that, first of all, if the asset's going to go up 198% a year on average for a decade, and that's the Bitcoin performance for the last 10 years, then incurring a bit of volatility to get 200% a year tax-free interest is a pretty good idea, because your alternative was gold, which is up 1.8% a year for a decade, or S&P, which is up 11% per year for a decade, or big tech via NASDAQ, which is up 16.7% a year for a decade, or long bonds like TLT, which is up 4.5% a year for a decade. So it's not even close. It's basically 20x better than equity and 100x better than gold. And volatility is a small price to pay. It turns out that the Sharpe ratio is better than any of those asset classes. So if you look at risk-adjusted returns, Bitcoin has by far the best risk-adjusted return in addition to the best risk returns.
Right. Okay.
And the story is the volatility is just going to continually decrease as the asset class gets bigger, as you would expect. Bitcoin's 922 billion, and gold's 10 trillion, and S&P's 32 trillion, and NASDAQ 17 trillion. So it doesn't take a rocket scientist to figure out that as the amount of monetary energy sitting in that network increases, the volatility will decrease. Likewise, probably the annual returns will probably decrease too, right?
Yeah, monetary energy in the network. I think there's an awful lot in there. And I wanted to, you mentioned taxation, you mentioned the public authorities. I want to kind of look at that. I mean, central banks, several central banks have talked about, some are even kind of launching plans to make quote unquote central bank digital currencies. These would be centralized, I assume, not decentralized.
Yeah.
Are they, what are they? They're not really like Bitcoin, I would imagine, that from the very get-go. And are they actually a threat rather than a sign that this is becoming adopted by the public sector?
It's not clear what they'll be. We'll have to wait and see. It'll probably take 4 years before we know that. But I think that we're looking at a duopoly system where you'll have asset. I mean, every investor is going to have assets. They're either going to be sitting in stocks, equity, bonds, gold, real estate, Bitcoin, and they're going to have some currency in their checking account, probably dollars. And as this grows, those central digital currencies are really just dollars flowing over a digital network. I don't think I don't think they really change anything. It's kind of comparable to Square or PayPal plugging into Bitcoin.
Mm-hmm.
If I have the Square app, I can have $10,000 of Bitcoin in a savings account, and I can have a checking account,
Right.
and I can pay for my coffee with dollars.
Right.
And then over time, I will either sell the Bitcoin or I will borrow against it.
Mm-hmm.
Right. I think when the dust settles, the ideal situation is 1 billion people all holding Bitcoin as their store of value and then borrowing with a secured credit line in dollars and euros.
Right.
And then moving that over conventional payment rails. And those payment rails, is it Visa? Is it MasterCard? In theory, a central digital bank digital currency could compete with Visa and MasterCard, right?
Correct.
But will MasterCard and Visa like that? Will the government do that? And
right.
Does it matter?
Yeah. Right.
Like I can do things. I can pay a $20 bill with Apple Pay, and maybe it moves through the MasterCard system, or maybe I directly debit it with a CBDC.
Yep. I see. Yeah.
At the end of the day, it doesn't matter.
I mean,
you're looking at a bunch of currency circulating day to day, which is how you pay your bills.
Right.
And then you've got a chunk of your assets, your monetary energy sitting in a store of value, which you expect to appreciate over the long term.
Okay. And so on taxation, which you've mentioned as well, I mean, governments, I think what you're saying, if I get it correctly, is governments may actually tolerate this because as long as it's not a currency, governments actually get a lot of benefit from issuing currency through a seigniorage. It's a really important benefit that they like to monopolize.
Yeah.
But if we stick more on the asset side as the collateral for getting currency, they may sort of leave it alone more than is that possibly
Bitcoin
how
is
the duopoly works out?
Look, Bitcoin is a competitor to gold.
Yeah. Right.
Look, gold's $10 trillion.
Yeah.
There's $10 trillion worth of monetary energy in gold. Why wouldn't it all move to Bitcoin?
Right.
Because Bitcoin is a better gold than gold.
So
Bitcoin is a million times better than gold.
Right.
And so, instead of thinking about it as a currency, think about it as an asset. And what it's really competing against is gold. And it's competing against, if you have money it's competing against savings accounts, but who keeps their money in a savings account anymore?
Right.
I don't think anybody does. So really, people have pursued ETFs as their store of value, right? The average person would take the money they want to save for a long period of time, and they would buy the S&P index or buy the NASDAQ, or they try their hand at stock picking. If they're desperate, they start buying GameStop or they buy story stocks. Otherwise, they buy an index. Over the last 10 years, right? Long bonds yielded 4%, big tech yielded 16%, S&P yielded 11%. Those are all kind of quasi store of values. If the monetary inflation rate is 6%, which is what it was, you can see okay, buy tech, and that's a good idea. Keep your money in bonds. I don't know. Gold is only 1.8%. Now, over the last 12 months, Bitcoin's up 450% and gold's up 3.6%. Gold's a disaster. It's breaking down. It's being demonetized by Bitcoin. So the most obvious trade is sell all your gold and buy Bitcoin, because the only people buying gold are people that want to buy a non-sovereign store of value that's not tied to a forecast of fiat cash flows.
Correct.
That's what Bitcoin is. So, but the problem with buying gold is the gold miners are your enemy. The gold miners are destroying the value of the gold supply. Whereas when you buy Bitcoin, the Bitcoin miners are your friends. They're really just creating security on a network that's got fixed 21 million coins in the day. So gold doesn't work as a store of value. The S&P is up 25% over the last 12 months, and so is the money supply. So you can see that stock indexes, money supply, they're both tracking equally. Big tech, NASDAQ's up 48%. So it's staying ahead of the money supply. Long bonds, TLT, 20 to 30 year dated long bonds, are minus 11%. You're getting destroyed because you bought bonds at the top when interest rates. you know, when the 10-year was 50 basis points and the 30-year swap was 72 basis points.
Right.
If you bought bonds then, well, now they're coming in. So that's not so good for you.
Sure.